You're going to love this interview. Just got done editing it. I'm glad I got it live for you. I'll be in the comments for the next 30 minutes hanging out, answering any questions you have. In fact, leave a comment below about data points or what you think is going to happen to the company, and I will respond to every comment. Additionally, if you're just loving the content, click the thumbs up and I will go and check out your profile as well and give your videos some love as well. In the meantime, enjoy the interview. Hello, everyone. My guest today is Ryan Urban. He's the co-founder and CEO of BounceX, a marketing technology solution that brings a logged-in experience to logged-out website visitors across devices. Under the company, BounceX has been ranked #1 for employee retention and career development by Computer World and named a best place to work by Crain's and Fortune. Ryan, you ready to take us to the top?
Yes.
All right. So
maybe Latka too.
Yeah, right. We'll see. So first off, thanks for letting us host the CEO format at your spot. You had a nice big move. So where are you now? You're in the trade center, correct?
One World X. Yeah.
And got to show people the view real quick. Turn the computer. Let them check it out.
You're gonna come with me.
Yeah, there you go. Walk us around. Look at this view, guys. If you're not watching on YouTube, flick over to YouTube. A hell of a view, right?
Mm-hmm. Yep.
Good stuff. So, okay, Ryan, so when you've pivoted in terms of messaging, I don't know if the product actually pivoted over the past couple of years. I mean, how do you describe it today in kind of a sentence? Is that right? A logged in experience to logged out visitors?
We evolved the messaging. So we've been around about 6.5 years, and we've always been focused on two simple things. So I had an e-commerce background, so did the other co-founders of BounceX. And we always focused on just driving revenue and improving experience. So it's over time the product mix kind of evolved. So we started doing email capture and being really good at that. And everyone knows like our exit intent stuff. Then we're like, hey, we're collecting all these emails. Let's do some triggers. So we rolled out like the product abandonment, and we started doing some triggered email and doing that at scale. And to scale triggers, you need identification because on e-commerce websites, less than 5% of people logged in. No one creates accounts anymore. So it's like, okay, let's scale all the triggers with identification. And yeah, over time, as kind of the business evolved, our messaging has updated. So now it's basically we've always been doing the same thing. We're on the side of e-commerce companies, drive a lot of revenue, and we improve experience. So
what's a lot of revenue, Ryan?
Typically, we're any business we work with, we're able to increase their revenue by say 5 to 20% within 90 days, and it's usually more in the 10 to 15% range. And that includes multi-billion-dollar companies. And the smaller company, our saver company doing, say, $10 million, we're usually more able to improve business by 15 to 25% pretty quickly. And normally we're typically a top 3 channel in someone's Google Analytics, and oftentimes #1.
Do your salespeople have to fight for that attribution, or is it crystal clear that's because they installed BounceX?
Well, the attribution is based on our clients' analytics. So and also when you fight over attribution when your product doesn't work. When your product works, it's like, whoop, you feel it's like, hey, whoa, I'm growing here. Wow, What's happening? Oh, yeah. So no, it's like, hey, your analytics, last click, like last click is not the best way to measure things, but you should be running control groups. But we're okay, cool. Just whatever's in your analytics, we're cool with that.
You take a % of the increase, or are you a flat kind of SaaS model only?
We're a flat SaaS kind of shop, but we'll typically do 3 or 4 month initial terms of pilots, which is very unlike most of the martech companies who require 1 or 2 year initial terms. And based on there'll be a monthly price there, but we'll have like a tiered pricing approach where based on how much increase in revenue, it will automatically go into another 12-month agreement at a certain flat rate SaaS. So
I see.
Based on basically our identification rate and how we perform during that pilot period, it can lock into a higher rate. So that's how it goes. But it's flat rate SaaS.
So when you look at the cohort right now of all the customers you're serving, I mean, help me understand like sweet spot. An average customer is going to pay you about what per month to use the tech or per year?
There's a median customer. I don't average is like a funky kind of thing. So the cohorts, I'd say there's three cohorts. So cohort #1 is the big ones, the megalodons, as we call it here, and those are the 7-figure ones. So those are the ones that are, they used to pay us between $1 and $1.5 million a year. Now we're getting some that in the $2 to $5 million range. Yep. So that's where we're moving on market quite a bit.
But that cohort, you call them your megalodons, they're all paying more than $1 million a year.
That's right.
Okay.
And then you have the bottom cohort, which is our minimum is $72K a year. Yep. So it goes $6K a month so companies typically doing $5 to $10 mil online. So the cohort paying us between $6K a month and I'd say like $15K a month, that's like that mid-market cohort. And then then we have the enterprise core, which is basically like the 20K to like that 50, 60K.
So you kind of have 4 megalodons and then enterprise, middle, small.
I'd say 3. There's strategic and there's like the megalodons, the big strategic ones. So
yeah,
and those really do move a business.
Yeah. Now, if you just add up the revenue from just your megalodons, does that make up more than, call it, 30% of your total revenue?
It's probably about that. It's not heavily weighted, which is good. We sign a high volume deals. We're signing almost 40 deals a quarter. So, and maybe we're doing 2 of the big ones a quarter. So
okay,
it's pretty diverse.
Okay, good. Now, two of those big ones a quarter means your new bookings per quarter then is well north of $2 million at this point. Our
new bookings in quarter is approaching $20 million.
Yeah, way bigger. Okay, very good. Now, when you look at this with the segment that's growing the fastest, are you generally focusing on
that's ARR, of course?
Yeah. When you're looking at what segment's growing the fastest, revenue the fastest, is it that top tier, or no? Are you seeing a lot of movement in the bottom tier?
It's end. So we should have moved to named accounts much quicker. So we mapped out our TAM, and out that 4,000 named accounts, we used to have SDRs, and now we kind of have an elevated version of that role. We call it a BDA, Business Development Associate. Uh-huh. So they're paired on a one-to-one basis with a new business rep. And, well, they'll maybe 80% of the time with one rep and 20% of their time with another rep to spread it out a bit. And they'll have like between 40 and 100 named accounts, depending. Mid-market will be more towards 100. Strategic will be more towards 40 or 50. And whether those are clients or not, their goal is to, use all the resources we have at Bounce, which is themselves, the rep, our marketing team, our alliance team, to break into the account at the appropriate level. So there's something called, we don't do leads. We have something called a sales accepted opportunity, which is like, it's the right company. We will map out the org, and we'll have like a group, like 3 or 4 people that if the meeting is with that person and the meeting went a certain way, then that's an approved kind of opportunity. So we have very high standards on that. So it's up to that business development associate to get in there, and also like post getting in there, then it's when we're an active opportunity, it's their job to move up the org, be on calls and meetings, kind of take notes, help facilitate the process. So it's like a farming system for our sales team, as opposed to like there's some SDRs are cold emailing email templates and hands over sales. It's not that. It's a very cohesive unit. So as we did that, moved to named accounts, we are just. It's not an and/or, it's an and situation of mid-market is growing, enterprise is growing, strategic is growing, megalodons are growing. And we're not at the point where we're a default setting. There's a point in like a SaaS company where like say Salesforce is your CRM, there's the default. And for email and for an e-commerce company, Exact Target was the default for a while. Demandware, which both these are Salesforce, is kind of the default. If you're a mid-market and e-commerce company, Shopify is your default. So for us, we are for identity resolution by default, but we need to make kind of one-to-one identity resolution a really established channel. And that once that channel is a default thing, then we're going to really start to see some special growth. I think.
You were serving 250 paid customers back in 2016. What do you got now today?
We're probably on about 1,000 websites.
Okay. So is that paid customers though?
Yes, it is. So
okay.
We don't do anything for free.
Yeah. So 1,000 paid. So I like this approach you've taken, right? So you essentially said, okay, I'm going to go look at all the e-commerce brands with more than X amount of GMV based off you probably got data from somewhere, obviously legally, but scraped it, whatever, paid for it. And then you map out the 4,000 accounts and you say, we want to get all these 4,000 accounts. You're at 1,000 of them right now. Is that accurate?
We have reps and BDAs to all those accounts. And then our marketing, and we just have, there's incentives everywhere to break into those accounts at the right levels. So, and then we have some other verticals. So we do a little bit of travel, it's a sister vertical, and we have a separate publisher team, which we completely broke out its own business unit and had that team completely focus on its own thing. And the UK is also, it gets treated as own complete business unit. And that's been really effective for us. So it's on sales org, it's on accounts org, it's on marketing. So our publisher business unit is growing 3x year over year. That'll probably do 25 mil itself this year. So
yeah, publisher business is like Forbes.
What's that? Yeah,
your publisher business. You mean like big
like CNN stuff like that. Yeah, we help publish a lot of ways. So we'll help them grow their email lists, help them drive subscriptions. We'll help them with creating new ad real estate. So kind of redefining what an ad should be. So we just take the approach of like, hey, if we're going to be in the e-commerce world, we're just going to be a true partner and be on their side. And understand where the business needs. And it turns out it's really simple. They just need revenue growth and they want to improve customer experience. So everything you do just really focuses on that and that only. So that then you don't want it doing cool stuff. You don't want it rolling out different features. It has to hit a certain increase in revenue for us to ship a product or feature. It has to drive increased revenue at least 2 or 3%, depending on which product it is. And for example, like say retargeting Criteo's whole business, which they're a multi-billion-dollar company, they only increase revenue about 0.5%. So for us even to have a product extension, which is basically a feature, it has to be 4x better than Criteo's whole business for us to ship something. And it has to improve experience too. It's not just, hey, let's go run more sales or send more emails. It's
You're talking about Criteo, Criteo, correct? Criteo? Yeah.
Yep.
Yeah. Now you had back, I know you chose not to go the bootstrap route on this thing. How much total capital have you raised to date?
No, I funded it myself at the beginning. And then the first year and a half, it was funded by the co-founders. So, and if you were going to join as a co-founder, I made you put in even 40K. Like you had to put in 40K if you're going to join.
So all the co-founders put in 40K?
No, some put in a lot more. One put in 190.
How many of you are there?
I'd probably put in 350 to 500, depending how I look at it. And there's just
Ryan, how many are there?
There was 4.
4 co-founders. So altogether, how much total did you guys all put in? Like $1 million, $2 million?
No, that's like 600K.
600 grand. Okay. Now
and then after we got to about 70K in MRR, so when we got to about the $1 million ARR point, then we had good pipeline. Then we raised a bit. We only raised, this is 2013, mid 2013. We only raised $1.5 million when we could have easily raised like 4 or 5 then. And so, and then we basically went the first almost 4 years on that $1.5 million venture money raised. We did take a little venture debt too, like some mezz debt from WTI. That was great. Now we work at Silicon Valley Bank.
What year was that, the WTI deal?
I thought it was probably the next year, 2014. And we just used that we've acquired 4 companies. So some that's used to fund some acquisitions.
How much leverage can you put into that? I mean, can you go buy a company if the deal price is $10 million in cash? Can you get away with putting up $1 million in equity and the rest in debt?
You can leverage about, depending on the strength of your business, somewhere between 0.8 and 1.2 times your ARR, and we can flex up a little more.
Wait, of your personal ARR or the company you're buying?
Your personal ARR. And then they're going to look at the company buying and how much money they're losing, et cetera. So you don't want to be too levered, but it's really underrated. And you give up the market's really good for terms. You can like
Ryan, are you talking like 2 to 6% kind of interest rates, somewhere in that range?
When there's going to be some that are 6%, some that are going to be more in the 10% range. If you're looking at like no interest for a certain period of time or very low warrant coverage, so you might give up like a point of equity. So, but the ones that are taking a little equity, they might or there's no covenants or there's minimal covenants. So very, very kind of friendly terms. You might be paying more in the 10% range, but that's still super cheap. So then you can raise your paid off, or you can keep like rolling if you like, if you're doing well. So
yep. You mentioned another venture round in 2017. What was that round for?
I don't think the venture questions aren't really the right questions. It's when you feel like you have product market fit or you have some marketing channels you can really explode on. That's the right time to do it.
Well, no, I mean, by the way, Ryan, I asked because there are 2 very different models. Some people bootstrap the whole time. Sometimes you get on a VC track, and a VC track is just very different, right? So didn't you raise in 2018? Didn't you raise $37 million from Battery?
So a good amount of that went on the balance sheet, but not all of that. So some that you used to like buy out some like early investors. So we put less than 30 on that, but we'll end the year with.
What do you mean you put less than 30 on that?
Well, we put less than 30 into the business. Some it went out to buy. Some had bought out some, or just there was some liquidity for some earlier initial.
Yeah, investors. So $8 million went to secondary, early founders, early investors, and about less than 30 went to the balance sheet.
That's right, and we're our cash balance is going up now, so we're close to profitability, but we're cash flow positive. So we'll end the year with a good amount of cash. So not 30 million, but a lot of cash. So now we're in a position where we don't need to raise money, but like we're coming off our 2 best quarters ever, and now we found some place where we can really hit the gas. And
now you did another $30 million round of Silicon Valley Bank a year prior, correct? That was equity.
That was a different debt line. It was a little less. So some was with Silicon Valley, some was with someone else, and that's something that we have the option to pull some we want.
So that wasn't actual dilutive. That was essentially like a term loan, like a revolver or something.
some was term, some was based on ARR. So altogether, we probably have about 60 into the biz, and then you minus the cash in your balance sheet, and we've probably deployed somewhere in the 30s.
Got it. So you still have like basically 30 cash in the bank. You've raised 60 in equity, and 30 has been spent to grow the business.
Some within 20% of that stuff, and let's assume that we'll end the year well north of 100 million in ARR. So,
are you past that right now, or you still need 3 months to break that?
It depends how you count a publisher business. So
how do you measure it?
If you're just looking at clean e-commerce SaaS, we're basically there. But if you count a publisher business, and then we'll be well past that.
Why would you not count the publisher business?
You could. It's if you look at the net revenue of that, it's a nuanced thing. So it depends how the way GAAP looks at the revenue from that. It changes all the time. So yeah, I look at it.
I was going to say, I would be counting every dollar. If it's cash coming in the bank, I'm counting it.
So this is what we're looking to. We're looking to basically to have a strong IPO. Some companies wait till like they're doing 300-400 million. Some companies go at like 100 million. What we'll probably do is we want to get our net revenue retention, which I hate the word. I don't use the word retention. I use the word client growth. But like our net client growth, I want that overall to be above 125.
What's it now?
130. It's one of the issues we had is we ran out of stuff to sell our clients. We sold through all the things. Seriously. So, and to ship special products takes like good teams. So we're in alphas with 2 really, really special products, and we're gonna acquire something great we could put our ID tech on top of.
But what's it now? So you want to get 125. What do you got now?
It's not that. I think we want to improve by 20%. I'll put it that way.
Okay, so you're above 100. You're above 100% though right now.
Some cohorts were much higher than that, and some cohorts were lower. So it's as you move down market, the numbers are lower. So it also depends on if if we're partnering with a marketing cloud and we're sending our stuff through. If we have our product suite sold through. So depending on the cohorts, we know the cohorts where we're right now 130, 140, and 1, you want to get more of those cohorts, and 2, like ship more products for those cohorts. So we're just in a core strategy perspective, this is the way that I look at it, and this is kind of important to say. So you could take your same product, move up market. You could take your same product, move down market. You could take the same product, move to other verticals. You could take your same product and move to other geos, right? You can do new products to the same market that you're selling to right now, or you can do new products to new markets. Anyone who does new products to new markets is a complete idiot. So the route that we've taken, and all these things require product work. Actually, the most product work is moving down market, and it's the worst. So we've just taken an approach that, hey, we're going to keep it simple. We're going to take our same product, move up market, which for us is a little more of an API approach. You always do that. You always move up market, and you focus your product moving up market. And then we're shipping new products to the same market. So our sweet spot is e-commerce companies doing between $5 million and $1 billion in your revenue. So the stuff we're shipping now is really focused on companies doing $1 billion to $40 billion in revenue online, and new products to the same market. So, and super narrowly focused on that stuff. And when we ship a product, it needs to be, we typically do things that are new to market, but it has to be so buttoned up, best in class, like just.
So what other metrics do you want to hit besides 125 net revenue retention before you start looking at IPO?
Overall, you want a predictable growth. So there's this magic number stuff. The difference between growing 40% and 70% is a huge. Can be a huge difference in multiple. Right now, growth is looked at as everything, but I want it. Your growth needs to be predictable. So that we're flat rate SaaS kind of lowers predictability. The net revenue retention will help with predictability because then we know, hey, if we're say had 200 in ARR and our net revenue retention 125, like boom, we're going to be at 240 the next year
with no new customers.
With no new customers, it depends what's up for renewal. So yes, with no new customers here. So you want to have that, and then the other, I would recommend only doing usage-based pricing or having shipping products that support usage-based pricing. So for us, that's going to be some API as a service, platform as a service stuff, some stuff that's maybe in active contact tiers. So a little more of a Marketo approach. You can't just make that up, and your industry has to support that. So make sure when you're shipping products or you're going to acquire a product that it's something that supports usage-based pricing. That like Shopify is almost a $40 billion market cap. They charge a platform fee, but transaction fee. So as businesses grow, they get the benefit of that. Where where our core business, our customers get the benefit of locking it at a rate. The rate is really high, and it's backing into a great return on spend number. But if their business doubled, they're just getting much more ROI from us. So, and that was helpful in the early days for us to grow. But we need other stuff that, like, hey, as our clients grow, that there's going to be a step up as well. So,
and what's your overall? I mean, so if you break 100 million in ARR this year, where were you a year ago?
Well, let's talk about where we want to be. We can IPO at like 40% growth, which growth is something that you do have a lot of control dictating. So that's like we're cash flow positive. So at the point where I feel really comfortable with product market fit on some of the new stuff we have and an acquisition we're going to make, we're probably going to make our first, like, maybe not 9-figure acquisition, but an acquisition in the mid-8s. Probably somewhere a companies we're looking at that have between 75 and 150 people. We're going to start rolling up a lot of MarTech.
So you're talking like 10 and 30 million in ARR-ish kind of range.
Between 10 and 40, yeah.
Yeah.
And it's going to be strategic tech, not opportunistic stuff. So stuff where we can put our ID tech on top of and just almost use it as a marketing channel too, where we can then go in and like go into all their customers and upsell our stuff in. An acquisition is a hell of a marketing channel.
Yeah, did you do any acquisitions last year?
We did one and wasn't announced. But yes,
okay.
It was.
Yeah, were you less than, you said you wanted to IPO at 40% year-over-year growth. I mean, were you less than 40% year-over-year growth the past 12 months?
It depends when you look at it. We'll probably finish the year more than that.
Okay.
I guess. But you have quarters, you have different goals. Q4, Q1, that wasn't the goal. You got to get the ships, intact. For us, it was like having a scalable sales team. You got to have the product market fit in your sales team. Now we always had like some real strong athletes, great performers, but like getting that enterprise mid-market team to a place where it's a machine, where you got the right people in the right process, and like we got that down now. So we know we can like hit the gas there. In a marketing standpoint, for our top named accounts, say our top 500 named accounts, like we want to go in at the CEO level. So it's like, how do you create these experiences where CEO will come out? So we just spent about $200K. We rented a private suite at the U.S. Open finals. We choppered these CEOs into our basically where our suite was, and we also had other CEOs out, and like so they got to kind of meet some other like CEOs or CMOs of big companies. They got to go to the Nadal final at a private suite chopper. So like you do, and we only have the top people from our company there. So it's an amazing experience. And then that way you can get your clients out. That's a good idea to get some of your prospects who are in active pipeline out, and then new prospects. So doing things like that, it might cost $200K, but it could really scale. There's a $500K version of that where you have John Macro in your booth with you, hanging out with you, right? So we want to do stuff next year. We call it the Bill Clinton budget. So have these like $1 million experiences. If you want to get the CEO target out, it's like, hey, we're going to go get Bill Clinton to hang out with us, but he's going to, instead of like giving a talk, he's going to play the saxophone, and he's going to be in a band with like Boyz II Men. And then Mike Tyson literally rents out a ring, and you get punched in the face by Mike Tyson.
Yeah.
Take a job with Sylvester Stallone.
And you're going to pay us for it. So that's good. Hey, look.
So it's like, take what Cameo does. Cameo, $100 to get a celebrity to do this. You go like we want to create a great experience for the celebrities and presidents, but to hang out with like CEOs.
Yep.
So, and that's where we're going to do marketing next year.
Ryan, we're running out of time here. Team size today. How many people?
It's about 400.
How many engineers?
What we've been doing as a business generally is it's been a less is more approach where we're doing smaller focused teams of much more senior teams. So as the business evolved, we've been hiring way more senior people and putting them in smaller teams. So our eng team is shipping faster than ever. It's probably 70 people.
70. Okay. And how many reps are actually carrying a quota, sales reps?
That's on ramped quota is much less. That's probably around 20. So it's not that much.
What about even unramped?
Unramped, probably in the 40 range.
40 range. Interesting. Okay. Very cool, man. Let's wrap up here with the famous 5. Number 1, favorite business book.
It's not a business book. The book that's impacted me the most is recently is the but besides Andy Grove's just a savage. So Andy Grove, that's easily the best book of all time. And the Robert Cialdini, any Danny Ariely book is amazing. It's like really gives some mental. The book that has the most impact on me in the last year is the Howard Stern interviews. So I'm sure everyone's watched Howard Stern. Reading a transcript of these interviews, the one with Madonna especially had some impact on me. It's like it just changed my mindset. It's like people thought like not being a rebel, like she was doing things to get a rise out of people. She was just doing what she thought was right. She's always doing what was right. And just reading, you have the most special people on the planet, and getting read a transcript of an interview with Howard Stern was like getting in the mindset of these special people like Lady Gaga, Madonna, everybody. It's Donald Trump was on there 6 times. So that was really cool. So that was the best one for me.
Number 2, is there a CEO you're following or studying?
Yeah, I've been really following the Adam Newman stuff. I feel bad. He should not have stepped down.
Yeah, I would have thought. Number 3, is there a favorite online tool you have for building your company besides your own?
Yeah, and look, like just give the right answer. Elon Musk is the most special person to exist on planet Earth in the last 200 years. So hands down, and no one should ever talk shit about that guy. Let's just state the facts here. No one's doing special things like that.
Agreed.
And I really appreciate Larry Ellison's back in the helm and getting trying to build a great product. Larry Ellison's a special guy too. So
you're talking to Oracle?
Yeah, Larry Ellison.
Would you, by the way, if someone offered you $1 billion to take your company out before you IPO, would you take it?
Not a chance.
Okay. And when do you think you're going to IPO? I think it's next year you file?
When we have those metrics, when we have product market fit on some of the new things where we have usage-based SaaS pricing.
But you think you can hit 40% year-over-year growth next year, and you want to hit that before you really...
Next year, I'm going to smoke that. So I really want to be at my goal. I don't want to be at less than 50% growth at IPO, and I also prefer my EBIT to not be more than negative 10%.
Yep.
I would prefer to be at 65, 70% growth. I want to be at accelerating growth.
Yep.
So,
okay, very good. What's your situation? Married, single, kiddos?
Also, hold on. People read so many books, so stop reading books. Stop listening to podcasts. People listen to much shit. If you listen to something, if you read something, you got to take action immediately. That's it. But people read way too much.
Yep, I agree.
It's stop reading books. Just go do shit.
So Ryan, situation: married, single, kiddos?
I'm an independent. So
independent, good. No kids running around?
I already have the best kids. I have a lot of them working. So.
And how old are you?
I am turning. I'm turning 40 in February, but I've unsubscribed from Asian. So if you see me, I look exactly the same.
All right, last question. What do you wish your 20-year-old self knew?
I wish my 6-year-old self. I really regret not dropping out of high school. I went to college, got a master's degree. It was a big mistake. Some people were just made to work. I should have been working at. I literally been working at 6. So if I told my 14-year-old self would be drop out of high school immediately, and then probably at the age of 16 go work for DoubleClick. That was 1996. I would have worked for DoubleClick then and would have got a 10-year head start.
Guys, BounceX launched back many years ago, 2011-ish time frame, hit that first $1 million in revenue fairly quickly, raised a little bit of money when they hit that $1 million run rate. But since then, basically used cash very advantageously, used a lot of debt. Today, about $60 million in equity into the company, $30 million still in the bank. Other portions of that were put towards secondary, but they're profitable today as they look to scale, helping these large companies, again, scale online digital marketing experiences across many different properties, over 1,000 customers today. Maybe IPO next year, we'll have to see. Ryan, thanks for taking us to the top.
Thank you. And also, don't quote me on the 30 million in bank, but we have a good amount of the money in the bank and it's growing. So
there you go.
It's not a bad thing. Be in control of your destiny. So, and you can see some of the founders are special founders. They're not there anymore. So as soon as things aren't good, so make sure you have a good relationship with your board, but control your board. Tell them what's up. So
thanks, Ryan.
All right.
You guys know I fight like heck to get these data points for you from these CEOs that rarely do these kinds of shows. If you want more shows like this, make sure you subscribe right now. We're trying to get 10,000 YouTube subscribers by the end of September here, 2019. And it would mean the world to me if you clicked now to subscribe. Additionally, I've got 2 more great interviews for you. If you want more data points from the world's leading SaaS CEOs, click and watch one of them right now.